Hey, I'm Bo Rogers. I'm a loan officer and I'm known as the Money Man. I wanted to do something fun today. It's kind of a trivia thing. It's myths about mortgage. Myths about mortgage. I believe there's 12 of them here. Let's go through them. I'm going to try to get through them as fast as possible. But what I'm going to do is just put the myth out there. I'll give you a little time to think about it in your head. Or if you just want to hit the pause button and think about what I just said and then hit play to get the answer, you can do that too. I don't care. I just want to help you. And I want to give you my expertise and my opinions on this. So here we go. Myth number one. If I pre-qualify for a mortgage, I'm definitely going to get the loan. Give you a little time. The answer is no! It doesn't mean just because you pre-qualify for a mortgage that you're definitely going to get a loan. As a loan officer, we can't approve or decline loans. Even if we run it through Desktop Underwrite or LP, it doesn't mean that you're 100% going to get the loan, because all we're doing is taking the data that you're giving us without documentation to come up with yes, the loan works, or no, the loan doesn't work. The only one that can approve or decline a loan is a mortgage underwriter. So your loan officer cannot approve or decline a loan. It's not on me. It's on the underwriter and the documentation that you provide to say yes or no to a loan. Question number two, you have to have perfect credit to get a loan. Is this true? A perfect credit actually to get a mortgage? Do you have to have I'll give you a chance, give you some time. The answer is no. I've never seen anybody with perfect credit or 850 credit. I've never had 850 credit. In 12 years of running thousands of applications, nobody has ever had an 850 credit score. The minimum standard on a conventional loan right now is 620. And the minimum standard on an FHA loan right now is 640. It used to be 580, but due to COVID restraints, they've pushed it up because they don't want any default on loans. But you do not have to have perfect credit score. 620 is not even close to perfect credit score. And most people don't know, but you can, if you with a 680 credit score, you can actually put down 3% on a conventional loan, 3.5% on an FHA loan. And this is an answer to a future question coming up, and it's actually the next question. The next question, do you have to have 20% to put down on a mortgage loan? Well, I just gave you the answer on that, so I don't even have to give you time to think about it. No. You can put down 3% on a conventional loan with 680 credit. You can put down 3.5% on an FHA loan with 640 credit. So that knocks out two birds with one stone. The next one is a myth that states that a 30-year mortgage is the absolute best loan option to have. I'll give you a second, sorry. The answer on that is not necessarily. I have a 15-year mortgage note on this house. It's the best option for me. I can afford a 15-year mortgage, and the amount of interest that I pay is so much less than that 30-year amortization. It makes a huge difference. I mean, even if you look at a 10-year, 15, 20, or a 30-year, just look and see what the options are and see how much interest you're paying over the course of time. The next question on here, or the next myth on here, is can you compare mortgage rates based on advertised rates? Well, the answer to that is no. Oh, dang, I was supposed to give you time to think about it. Sorry. So the answer is no. You can't compare on advertised rates because there's a number of different factors that comes up with your mortgage option. It's your credit score, it's your debt to income ratio, it's, a number, it's debt to income, credit, these are things that matter, loan to value matters, and this is where they're going to come up with a rate. And that's why we want everybody to fill out a mortgage loan application so we know the entire scenario prior to actually quoting you a rate. In addition to that, when you look at advertised rates, make sure to read the fine print that's on the very bottom of the advertised rate, because you could add points into a loan which make the rate look way more attractive, which makes it to where you have to really pay attention to the annual percentage rate, because I can write a loan and ask you what rate do you want and basically do that rate for you, but it's based on what I'm putting into the loan. What does it cost to get the loan? How much is the bank charging you? So you cannot judge a loan just by advertised rate, because it just doesn't happen. Just when you're getting a mortgage loan, if you need to shop around, shop around. But the advertised rate is not a way to do it. All right, next myth. It's always better to own a home than to rent. Give you a second. All right, so this is a hard one for me, because I always think it's better to build wealth and own a home, because when you're renting, all you're doing is making the landlord richer. Like they're making money off that property they're renting to you. Most of the time, I bet if you did the math, you would find that owner is making a few bucks in addition to, this is after he pays all the bills, he or she pays all the bills for the property that you're being rented, which would include your mortgage, principal and interest, your taxes, your insurance, and if you have homeowners associations on top of that, I guarantee you they're probably still making money on top of that. Even though they're going to write off a ton of it, they're probably still making money. So you may look at it both ways. Sometimes it is cheaper to rent than it is to own, but you need to really do the math to figure it out. And some people just aren't ready to be homeowners, and that's totally understandable. Like when you own a home, you're gonna have to have somebody mow a yard. If the plumbing goes out, you're responsible for that. If your washing machine overflows on the floor, you're responsible for that. There is a lot into it to where when you're a renter, you can just call the landlord and say, hey, come fix this. So there's a lot into that question. Realtors aren't gonna like that question, so sorry. The next myth is escrowing taxes and insurance a good idea. Do you know what escrowing is? So escrowing is for taxes and insurance. So your taxes are due at the end of the year. Your insurance is generally due, so when you close on a loan, let's say you closed in October. Well, every year you're gonna have your your homeowner's insurance come up for renewal. What the bank does is they have a system to where they'll escrow that money, kind of put it over here in a savings account for when it's due, and then they'll pay that company or the county when that's due. You do have an option to not escrow taxes and insurance. I don't escrow taxes and insurance. The reason why is because I have a very smart financial planner who is making money on my money, into which if I can make a percentage off that money and just pay it at the end of the year, I'm gonna do it because I know how to save money. For those of you who like to spend money and cannot save money, an escrow account is a bravely great, tremendous idea. You probably need to escrow. But if you're financially sound and you can save money, you don't have to escrow. So that's kind of a blank question. There's not a right or wrong answer. It's based on a situation. The next myth that I have for you is, can you contact a lender too early before buying a home? I'll give you a second. The answer is no. You really need to prepare yourself to buy a home. Do you qualify for a home? We don't know until we know. Why would you even waste the time on, getting a realtor involved and going out looking at homes if it's something that you can't afford or you can't do? Reach out to your lender first and get pre-qualified. Go through it. Go through the app. It doesn't cost you anything. There's no obligation. You don't absolutely have to buy a home just because you do a loan application, but at least you know if you can afford a home or not. So it's never too early to reach out to a lender before buying a home. Next myth. An adjustable rate is only good for risk takers. So I'm going to explain that a little more. So you have a fixed rate mortgage, and then you have what's called an ARM. Most people are freaked out by the word ARM because they hear in 2009 that a lot of the people that defaulted on loans had ARMs. And this can be true and cannot be. So an adjustable rate mortgage works like this. Like, you're going to get a better interest rate on an adjustable rate mortgage. And they have different adjustable rate mortgages. They have 5 ones, they have 7 ones, and 10 ones. And so when you do a 5-1, everything stays the same for 5 years, same payment for 5 years. The 1 means it can adjust once a year. Most of these products are 5-2-5 products. So what that means is, let's say for instance, you started with a 2% interest rate on a 5-1 ARM. Nothing is going to change for 5 years. You're going to make the same payments. Adjustments can happen after that 5-year period to where it can go up 2% once a year, and the max it can go up to is 5% over your starter rate. This is an adjustable rate mortgage. They also offer a 7-1 and a 10-1. In some circumstances, it is better to do an ARM as far as the cost of doing business and the cost that you're going to pay to the bank. They're all based off of 30-year amortizations though. So you definitely look into it. It doesn't hurt. If you know you're going to relocate or not live in the same place for a long period of time, adjustable rate mortgages should not be scary. So it's not just for risk takers. It's for people that are financially smart, that are looking for the best option to save the most money. So it doesn't hurt to look into an ARM product at all. The next myth, a lender denied me, I can't get a loan. This is not necessarily true. So I didn't give you time to think about it, but I'm going to go ahead and go. So just because one lender declined you, that underwriter, it doesn't necessarily mean that you can't get a loan. Maybe there were overlays with the bank. I know when I worked for the big banks, they had a lot more overlays than the smaller banks. And some of the smaller banks still have overlays that the brokers don't have. So just because you're declined at one place doesn't mean you're going to be declined at another. I had a customer recently that came from my buddy Shinoda, who I could not get approved through the bank. I couldn't make it happen. I did everything in my power to make that happen, but I couldn't make it happen. But I happen to have other friends that are in the industry that work for other banks that have their own portfolio loans, to where my buddy Rex Dobrinsky helped us out, got a loan approved for the guy, so now he's in a house. He had to use a portfolio loan to make it happen, but he made it happen. So just because you're declined at one place doesn't mean you're going to be declined at another. You need to check with a mortgage loan professional, a loan officer that knows what they're doing and able to get you to the right place. The next myth is income determines how much a loan you can get. I'll give you time. The amount of money that you make determines the loan you can get. All right, back to the answer on that. So yeah, income does play a role into the amount of loan you can get, but something else that plays into that is your debt to income ratio. So just because you make a lot of money, if you spend the same amount, your debt to income sucks. But if you spend a lower amount, this gives us room to be able to get you a mortgage loan and get more of a mortgage loan for you for a bigger house, depending on what you want. So income matters, credit matters, and debt matters when it comes to this matter. Does it matter? It does. Next myth, FHA loans are for borrowers, I like to call them customers, with no money or poor credit. I'll give you a chance to think about that. So FHA loans are better for people that are more challenged. And what I mean by that is it has a low down payment. FHA loans have a 3.5% down payment. Here's the negative side about the FHA loan. Once you start an FHA loan, you're gonna have mortgage insurance. You can't get rid of it. It's like that disease or ailment that you can't get rid of it. It keeps coming back. But the only way to get out of it is to sell the home or refinance the home. So that's an FHA loan. The credit is not necessarily poor because now the standard is 640. I just told you that you could do a loan with a 620 credit score with a conventional loan. But on the conventional loan, if you have that low credit score, the debt to income will start to mess with me because maybe you can't go over 36% debt to income, Whereas on an FHA loan, you can go up to 50%, sometimes a little bit higher depending on the circumstance. So the poor credit part is not really a factor. The no money part is not a factor. There's only one loan that I offer that is a 0 down, and that's a VA loan. So if you're a veteran, you can get into a house with 0 down with your eligibility. But on FHA, it's 3.5%. So it's not necessarily people with no money. You still have to have money, and you still have to have okay credit at least 640 on FHA loan. These are the myths that I went over with today. I hope it was an educational video for you. And if you have any questions or I can help you out in any way, my name is Bo Rogers. I'm the Money Man. My NMLS number is 620948. We're an equal housing lender. My phone number is 214-507-2264. I'm always happy to help if you have a mortgage related question, either purchase or refi, or if you're just looking for an equity line of credit, or if you're looking for commercial. Whatever it is you're looking for, I'll know the right person to get you to. If it's something I can't do, I'm a book of knowledge and I am resourceful as all get out. My networking group's huge. I'd be happy to help you.